Hi, my name is Sandeep and I'm the policy analyst here at Renans. And today we're going to be talking about the long-term capital gains tax. Now, by now, most of you who are watching this video are probably aware of the long-term capital gains tax, and you probably also know what it is about. The purpose of this video is to sort of just clear up any sort of confusions that you might have about it, and hopefully we can provide you with some insight about what you can do about the tax itself. So let's start off by just quickly going over what exactly the long-term capital gains tax is. Now, it's a tax that's levied on capital assets such as real estate or equity shares or other products related to equities. The way it will work in India is that if you make a profit that exceeds 1 lakh rupees on a capital asset that you own for longer than a year, you will pay a 10% tax on it. So just to be clear, this is only on an amount above 1 lakh rupees. So if your profit on a capital asset that you own for more than a year is 1,50,000 rupees, you will be taxed on the 50,000 rupees. So 10% of that would mean you'll be paying 5,000 rupees at the end of the year. Now the tax comes with a grandfathering clause, and the grandfathering clause is essentially a clause that's supposed to protect those investors who have made decisions based on previously existing policies. So the way this clause would work is that all capital gains that you have made up to the 31st of January would be exempted, so you wouldn't pay any taxes on that. The tax itself would only begin to take effect if you were to start booking profits after the 31st of March. So from the 1st of April onwards, if you were to start selling stocks or shares or whatever it is on that sale that you would start paying taxes, the profit that you made in that period of time. So even if you were to sell an asset before the 31st of March, you still would be exempted from paying tax. It would only come into effect from the 1st of April. Now, after the 1st of April, once you start selling your assets, the assets that you've held for longer than a year, the way the long-term capital gains tax would be calculated is based on the acquisition price or the closing price on the 31st of January. So whichever is higher on the 31st of January between the closing price and the acquisition price, they would take the higher amount out of those two and levy a tax based on the highest amount. And this is only for those capital assets that you've held for longer than a year that you choose to sell from the 1st of April onwards. So why was the long-term capital gains tax introduced? After all, it hasn't been around for nearly 13 or 14 years. Well, the finance minister's explanation for this was that on average in India we see about 3.5 lakh crores of gains in profits on capital assets, of which no taxes are paid at all. So he believes that by adding a 10% tax on this 3.5 lakh crores, that the government will see a revenue of anywhere between 20 and 30,000 crores a year. Now, on the surface, it seems to make sense because when you look at the richest people in the world, their primary income comes from capital gains, their real estate holdings, their equity holdings in various companies. And so it would make sense that they pay some tax on this income. But the situation in India is slightly different, and therefore maybe the long-term capital gains tax doesn't make as much sense. The thing is, in India we have a really poor tax compliance rate, and for this reason we have something known as a securities transaction tax. The security transaction tax was introduced to mitigate against this poor compliance rates, and perhaps it would have made more sense from the government's point of view to actually tinker with the security transactions tax in order to achieve the same goals that they set out to achieve with the long-term capital gains tax. Now, it's important to remember that with the LTCG, it sort of takes away incentives from investors because you are taxing gains. So people may not want to invest as freely as they did before this policy came into effect. In fact, the Indian markets have been facing pressures from the Singaporean markets and the Dubai markets, and over the last 10 years, portions of the Indian markets have been exported to these two markets simply because they have greater incentives. So it might not have been the best idea for the objectives that they tried to achieve. It may have made more sense to do something with the security transactions tax where you could have taxed at the source rather than with the long-term capital gains tax where the tax is at the sale, right at the end. And all it really seems to be is another poorly thought out financial policy from the finance minister. And that's it for today. Thank you very much for watching.